presentation, this beautiful presentation up and running. Tiffany, if you can go ahead and confirm, you can see my screen.
Yes.
Awesome, perfect. So if you guys have any questions along the way, feel free. There's a chat button, there's a Q&A button. Either one works. Chat's probably preferred, so we can keep track any questions that come up throughout this webinar. So thank you guys again for attending. Now let's get right into it. So who is this for? So this presentation, this webinar, is for someone who's looking to understand the 2025 tax law changes and beyond, right? There's a lot of pros, a lot of cons as well. So I'm going to touch base on as many as I can, pretty much in this webinar. It's also for high-income W-2 earners and business owners, and those with large tax bills and complex financial situations. So why does this matter? As I mentioned earlier, taxes are their number one expense, right? So we want to be proactive with this. So whoever's attending today already has that mindset, already being proactive. You're already ahead of the curve. I can tell you, but for more than 80% of those that are out there. So there's recent tax law changes that may create new opportunities and risk for high income, right? And there's many high earners unknowingly overpaying in taxes, right? So we're going to address a lot of these changes in this bill. Just for those that don't know me, for those that are new, my name is Kevin Andrade. I'm a CPA licensed in the state of Maryland. I'm the founder of Spark Tax Services, LLC. I have over 10 years of accounting experience, and I've helped my clients save over $2 million in taxes year to date. So with that said, the agenda of this webinar, we're going to cover individual tax changes, 2025 tax law affecting personal income and deductions. I'm also going to go over business updates, new rules for businesses and pass-through entities, planning strategies, tailored approach, and a bonus, a free gift for those that stay till the end. So what is the OB3 Act, or One Big Beautiful Bill, right? We're calling it OB3 for short. Internally, IRS may call it something different. One Big Beautiful Bill, pretty much passed July 4th, 2025. It affects income tax, business deductions, estate rules, and much more. Again, over 100 provisions. It contains new breaks and sunsetting a lot of credits. So tax credits. So the timing is incredibly critical. So let's go right into it. So what's the number one change that affects everyone, right? So the federal income tax brackets. Tax rates are going to stay low. So this is a temporary change. Under the old bill, it was going to increase for high income earners from 37% to 39.6%, and even low to middle income households as well. Your taxes were going to increase from 12% to 15%. So across the board, everyone's going to get between 2 to 3% tax increase if the new bill didn't pass this type of law, right? This would have been for 2026 moving forward. So what they have done now is made the tax rates stay low. This is a temporary change. They pretty much kept the current rates. Now, historically, we are in the lowest tax, what do you call it? We call it tax burden, tax bracket in U.S. history, right? It doesn't feel like that, right? Trust me, I know. Yeah, if you feel it in your paychecks. So ideally, what they have done is keep the tax rates that were from the Tax Cut and Jobs Act of 2017, and they extended it through 2029, right? So this is a temporary change. Everyone can utilize these tax rates. So this is a win. It impacts everyone. Your federal taxes were going to increase 2 to 3%, which would have been bad. More taxes. Who wants that? So tax rates stay the same. Another change, and this is a permanent change, higher standard deduction. So before 2017, there was a low standard deduction. So what's the point of a standard deduction? The standard deduction is to pretty much lower your taxable income, right? So because the taxable income is what you're going to be taxed on. Well, in 2017, they increased it. They pretty much doubled the standard deduction. It's been increasing with inflation year over year. And what they've done is in the old bill, that was going to go away. And what they've done is made that permanent, right? That bigger standard deduction. So it's more money in your pocket, essentially, right? And what they did was adjust it for inflation a little bit more. So for single filers, standard deduction is $15,750 for 2025. And if you're married filed jointly, it has increased from $30,000 to $31,500 for married filed jointly. So it's just more income that's shielded from federal tax automatically. You don't have to do anything. Okay. So it's reducing the number of households needing to itemize deductions. So this helps everyone. Again, another good positive thing that came out of this bill for tax purposes is a higher standard deduction for everyone. Okay. SALT. SALT standing for state and local taxes. What is SALT? So state and local taxes, pretty much all the state taxes you pay, your property taxes within your state that you pay for your primary residence, right? All that gets put into this category called SALT, state and local taxes. So there was a limitation under the old law where the maximum you can do is $10,000. And this hurts a lot of folks that have high property taxes and high state taxes, right? They're capped at that 10,000. They can't go higher than that for itemized purposes. Well, now the cap has been raised from 10,000 to $40,000 for state and local tax and this is a temporary change from 2025 through 2029, so the next 4 years. This helps high state tax state residents benefit the most, so New York, California, etc. And phase out starts at $500,000 AGI for joint filers. Pretty much 600 after 600K, it's gone. It's a reduced benefit at high incomes. But if you're implementing these tax strategies that could reduce your AGI, awesome, because you may qualify for this this itemized deduction. Again, the cap is now $40,000. If you're less than that $500,000 mark, if you're a joint filer, if you're single, it's pretty much half, which is $250. Okay, so this is a big deal. This is a big deal. Removing that cap, right? Especially with our current environment, with high interest rates, with home mortgages, it just makes sense to do itemized in some scenarios, but sometimes you're just handcuffed from a tax perspective, right, with the $10,000 limit. So this is a huge, huge win for many folks out there. Expanded child tax credit. So the expanded child tax credit, under it was supposed to expire. It's pretty much $2,000 per child that you're going to get as a credit, and the credit reduces your tax liability. Okay, and with the old law, it was going to go from $2,000 down to $1,000. So what they did was in this new reform was they not only kept it at the expanded child tax credit, but they also increased it to $2,200 per child. Again, this is a temporary change for the next 4 years. There are phase-out thresholds, right? This begins at $400,000 for joint filers, and then you just pretty much slash it in half. So for single or head of household, it's $200,000. So that's a good change for all those kiddos that you guys have. Again, this credit applies for those that are less than 17 years of age. Now, there's a refundability portion of it that's going to help out a lot of low-income households because what happens is the credit was non-refundable, meaning you can only reduce it down to zero. But now there's a refundability portion of it that you can actually get money back if your taxable income is zero. So this is awesome. This is a great incentive. This is just another pro that's coming out again from the tax bill. If you're just joining now, just a quick reminder, if you have any questions on any of the topics we're coming, feel free to put it in the chat and we'll monitor it as we go. All right. Another provision. Very, very popular topic. Still popular as we navigating through this topic. Tips deduction. Yes, this is a temporary change. It's brand new. So pretty much up to $25,000 of earned tips is now exempt from federal taxes. So how it's going to work, I don't know. I don't know exactly yet. I'm sure there's going to be guidance coming out. There's discussions of how to report it on the W-2, and then there's discussions on how it's going to be reflected in the tax return. So I'm sure as we get closer to the next filing tax season, there's going to be more guidance coming out from the employer side for payroll, and then another side is going to be from the tax return reporting purposes. Now, I've already been asked this question, so let me address it here in case you're thinking it. If you're a business owner right now, and you're already paying yourself reasonable compensation, a W-2, can you just carve out a portion of it as tips, parentheses, quote, as tips, and pretty much report that as, federal taxes exempt? The answer is no. All right. Or it could depend, right? I'll say it depends. It's because it depends on the industry that you're in. So there's something called SSTB, which is a specified service trader business. If your profession falls under the specified service trader business, you cannot utilize this deduction. This includes lawyers, it's attorneys, medical professionals, accountants like myself, financial advisors, insurance. So pretty much think about like if a profession industry that you're in that you don't normally have to tip, right? When have you got insurance, home insurance, and you had to tip the insurance agent? Probably not. Or even tip an accountant. I would love tips, but ideally we don't accept tips. But that's not a normal transaction, right? So this really benefits those that are in the hospitality industry, Uber drivers. If your industry is those that you get tips, this is now going to be benefit to you. Also, there is an AGI limitation. What does this mean? It pretty much, if you earn more than $150,000 if you're single or $300,000 if you're joint, there's this deduction is going to reduce on how much you can reduce it by, and that phases out as you earn more income. So that's the tips deduction. Reporting wise, still TBD. We'll see. We'll figure out how that goes. Overtime. This has been an incredible big topic in the tax space. I mean, almost every day I'm in a group where they're talking about this overtime pay, how it's going to work. There's guidance that just was reported by one of the tax professional industries out there literally this morning on overtime pay because there's a lot of confusion. So here, especially on social media with people that are not tax professionals. So let me break it down for you here. So you can deduct up to $25,000 of qualifying overtime pay through 2029, so the next 4 years. It must be documented separately on the W-2 by your employer. It applies only in the half in time and a half. So most of the time, if you're getting paid overtime, you get paid time and a half, right? Your base plus 50%. So it's only the half portion of time and a half that's going to be considered overtime pay as the tax deduction, right? Tax exempt, up to $25,000. And then similar to the tips, it phases out over $300,000 AGI for joint filers, and it will be applied as a deduction on your 2025 tax return. So a lot of moving pieces on this one, a lot of confusion, but that's pretty much the basis of it. It's the half and time and a half. It's not your base pay. How they're going to report it on your W-2 is to be determined, and then how to report it on your tax return is to be determined. Again, a lot of changes that hopefully it comes out sooner rather than later. Last thing we want is a scrambling during tax season. But regardless, I know our services, our firm is going to be prepared for everything. We're on top of it, reviewing law consistently, pretty much on a daily basis. So, any questions so far, Tiffany, before I move on?
All good for now.
Okay, cool, awesome. Something new, senior $6,000 deduction. This is also a temporary change that's through 2029. This has caused a lot of uproar. I know my mom, because she's one of these, um, because there was a promise during the campaign of the current administration that how do I say this? Social Security benefits are going to be tax-free, right? That didn't happen. A lot of discussions didn't happen, but what did happen was they gave the seniors, pretty much if you're 65 and over, receiving Social Security benefits, or not even Social Security benefits. It's just matters if you're senior, 65 and over, a taxpayer, you have an additional 6,000 if you're single, or 12,000 if you're joint filers, as another standard deduction on top of the regular standard deduction, right? Which was great when I first read it. And then you see the little caveat disclaimer note at the bottom that said, only if you make up to $75,000 if you're single or $150,000 if you're joint. Okay. If you're a high income earner, you're going to probably pass that fairly quickly with just some capital gains, right? So perhaps meeting with your tax professional to, allocate to see perhaps, play around with the numbers to get under these thresholds so you can qualify for a larger standard deduction. Car loan interest deduction. I have mixed feelings about it. Overall, it should be good, right? So the deduction interest is up to $10,000 of your car loan interest through 2029. So again, next 4 years. You can see everything's temporary. Next 4 years, that's when the current administration rolls out. And then who knows, right? It makes my job very entertaining, right? Every 4 to 8 years. So car loan interest up to $10,000 of car loans, and it's only available for personal use vehicles only. This does not apply to business vehicles, only personal use vehicles. Okay. The requirement is that it must be pretty much assembled within the U.S. So this is similar to the EV tax credit, right? That it was assembled and manufactured within the U.S. Again, guidance is supposed to be coming out. I'm sure there's a list already floating around the internet of possible qualifying vehicles. And then they put this caveat on here as well. So the phase out begins if you're married filed jointly of $200,000 joint, AGI and above, and then if you're single, $100,000. So That's pretty low. For someone who's paying up to $10,000 of interest, earning less than $100,000 if you're single, that's 10% of your paycheck in just interest. I can't think of a scenario where that's actually like if there's I'm sure there's people out there, but it's not necessarily a financially sound investment just to get a tax deduction, right? So that's why I have mixed feelings about it. Um, cool, you get a deduction, great if you qualify. But I wouldn't leverage it as like, oh, because this came out in the new bill, I have to get that BMW or that other vehicle that I was looking at. So car loan interest, great. If you're already going to purchase a car, fantastic. If you meet these thresholds, right? Um, which is awesome. So take that as you will. Any questions with that? Let me know. QBI deduction. This is my business owners. This is a big, big deal. This was a huge deal, actually, for all my business owners that are out there, or if you're aspiring to start your own business. This is a big deal. So 20% of QBI deduction. QBI stands for Qualified Business Income Deduction. It came out something new from 2017, Tax Code and Jobs Act. It's pretty much a 20% deduction without you having to do anything, right? So let's use an example. If you made $100,000 in net profit as a business owner, and you get an immediate 20% if you qualify, 20% QBI deduction, 100,000 minus 20,000, it's $80,000 that's left over. $80,000 is now your new taxable income without you having to do anything, right? It's just an automatic deduction, which is awesome. This was set to expire at the end of this year. Um, and most of my clients and myself, I'll be guilty of myself. We've got used to this QBI deduction, right? That we were able to reduce our taxable income. And with this sunsetting, that would have been increasing our taxable income and increasing how much taxes we had to pay. So this was a huge, huge deal for many, many business owners out there. It applies to business profits only, and if you're not an SSTB. So just a quick refresher, SSTB, attorneys, accountants like myself, financial advisors, insurance agents, medical professionals, anesthesiologists, like those folks, SSTB, we have limitations on QBI. So what they did was they modestly expanded it for those folks that are in this SSTB, but there's ways a workaround, I should say. So the workaround is to make sure to calculate your reasonable compensation, perhaps even leverage other tax planning strategies so you can get under those thresholds. Typically, it's around $400,000 if you're married, 200,000 if you're single. So trying to get under those thresholds so you can qualify for QBI is a big, big deal. QBI, it's applicable for S corps, partnerships, 1065s, sole proprietorships, any pretty much self-employed income that you earn. And still subject to W-2 wage and qualified property test for high earners, right? But big, big deal, big win. Another big win. And I forgot to mention, this is now made permanent. QBI is made permanent, which is a big deal. I love it. Bonus depreciation. Another big, big win. A lot of wins. I'm giving you all the goodies right now. So 100% bonus depreciation is back. And it's back with a vengeance because not only is it back, but it's made permanent. So bonus depreciation was slowly going down over the years. And the whole point of bonus depreciation is pretty much to get a negative loss to offset your other types of income if the scenario makes sense. Usually there's material participation involved or rep status, depending on what you're trying to accomplish. But the whole point of bonus depreciation being back means you're immediately able to write off capital equipment, technology, furniture, and machinery at the federal level. Big, big deal. At the state level, some states recognize bonus, some states don't. Some states recognize Section 179. So make sure you contact your tax professional to see if whatever asset you're purchasing qualifies for the bonus for your state. But for federal, immediate full write-off, which is great. Now, the effective date applies to purchases placed into service. So you have to purchase the asset and place into service after January 19th, 2025. Okay. So this is a huge, huge deal. I have clients that just were right a few weeks under that January 19th date, which unfortunately they won't qualify for the 100% bonus. So we have to utilize the old law. Caveat or a little quick tax tip. Just because you have bonus doesn't mean you need to use it. Okay, it just depends on your unique scenario. For example, if you're a business owner and you purchase equipment, but your profits are a little bit dipped or lower than expected, then what you can do is just utilize it, depreciate it over the useful life, right? That's an opportunity there. Um, Another quick tip is bonus depreciation is great for 6,000 vehicles that are 6,000 pounds or over 6,000 GVWR, I should say. GVWR stands for gross vehicle weight rating. Okay. Um, it's kind of a workaround or a little loophole because their intention with this provision, I guess you could say, back in 2017 was to incentivize business owners to purchase like large vans, equipment, vehicles, large vehicles, right? For them, mostly like the construction and trade businesses. Well, it wasn't until we quickly realized right after that that it applies to everyone really to purchase a business vehicle over that GVWR. You can see a picture of a G-Wagon. It's very popular. 100% bonus is you know, very, very important for real estate investors now. Um, is real estate a thing that you should get into right away? This is definitely, um, if you're stacking up value, this is definitely a big, big stack of on top of the value to invest in real estate. I think there's one more change that needs to happen, and that's going to be the decrease of current interest rates, because right now to borrow debt is very expensive, right? Um, and it's just a matter of time. They're already talking about it. So as soon as interest rates starts to go down, plus you have bonus depreciation being permanently back, I can see a huge boom in the real estate market as soon as interest rates start to come down, a lot of refinances, etc. So that's an opportunity to talk to your tax professional to see any real estate strategies for yourself. All right. And equipment.
Hey,
Equipment's a
Kevin,
fantastic thing. Yes,
we have
talk
a
to me.
question here from Jake. Why January the 19th and not the beginning of the year? It seems like a random date.
You're telling me, Jake. Again, I'm just giving you the information. January 19th is the date that Mr. Trump was inaugurated, if I'm not mistaken. So for whatever reason, they went back to that specific date. Yep. Any other questions? Great question.
We can continue.
Okay, cool. All right, moving on to Section 179. Section 179, the limit was raised and the limit was raised permanently. This is a big, big deal as well. Section 179 is pretty much somewhat of a form of bonus. Um, and so it increased to $2.5 million of a maximum deduction for qualifying purchases, and then there's a phase out at $4 million. It's ideal for bundling assets in a single year for full deduction. So in a combination, your tax professional should be doing the calculations in the back end. What you need to know is, can I accelerate this asset to benefit me, depreciate it faster this year to reduce my taxable income? And the best way to do that is to leverage OPM, other people's money, whether that's buying a vehicle at the dealership, whether that's buying equipment, whether that's buying software, whether that's buying real estate. You want to utilize other people's money, right, to get the asset and then boom, accelerate depreciation, wipe out your taxable income. So that's the goal, right? Now, their tax professionals on the back end is going to be doing calculations, on the spreadsheet, Section 179 bonus, how that looks like. What you just need to know is purchase these assets, place them in service before December 31st, get that accelerated depreciation. R&D costs, research and development costs. This is a tax credit. It's not new. It's been around. Um, and it's good, but now it's even great. So an R&D cost is pretty much research and development. Like if you're creating, I'm trying to think of another client example. If a client owns a restaurant or a brewery and they're trying to come up with their own concoction of a beer, right? So it takes time, the flour or like the wheat, the processing, the equipment, the time that it takes to test, not test, all that is research and development. And what happens is you can actually now take a tax credit, okay? You can utilize that tax credit within the same year and not only fully expensive, but take a credit against your tax liability, which is a big deal. Um, and before you had to amortize it over 5 years, now you can take it up to into the same year, similar to like think about it like 100% bonus depreciation. It's just another power punch for business owners and companies to think about R&D. Now, what I know of a lot of business owners that are thinking like, what's R&D? Like what qualifies for R&D? I think that's a separate conversation. I'm not going to go deep into it now. Honestly, this is a strategy I put on the shelf, and I have to come back and dust it off and read back into it and read how we can apply it to some business owner clients. But R&D tax credit includes software development. That's also something new. It's a big deal. So it's an incentive to boost innovation and for tech-driven businesses, right? It's just more tax planning strategies for our techs for our business owners. This is a big deal for AI. There's a lot of people out there that are messing around with AI, creating new processes, forms, or even creating brand new products, brand new software. So we're definitely going to go deep into this strategy soon. But now it's even sexier. Now, let's start going to I guess, dwindling the green credits. So there's I mean, everyone probably here probably knows the falling out between Elon Musk and Trump that occurred, probably because of this. I don't know, to be honest. I'm just spitballing here, making a little joke. So EV and green credits are now expired or gone. It depends. So let me go to the next slide to give you exactly what has happened. So residential clean energy and home efficiency credit. That is now completely gone. They put it in the bill as like the deadline's December 31st, 2024, because we're still in the extension season. Some people filed extensions, so they're still trying to file their tax returns. So that's why they put 12/31/2024. But technically, January 1st, 2025, it's gone. Adios. And so what does that include? That means like if you put like a dishwasher, a refrigerator that's home energy efficient, windows. You may have been told by somebody that like, oh, if you buy this product, you get a credit. Now that's gone. So sucks. Another one that's gone. New and used clean vehicle EV credit. EV stands for electric vehicle, by the way. So Tesla is the most popular one, but there's others out there. The deadline is 9/30/2025, so that's going away. So that credit is $7,500 for new EV vehicles, and then $4,000, if I remember correctly, for used EV vehicles. There are income limitations similar to the other provisions that we just went over. For EV, it's 150 if you're single, 300 if you're married, pretty much of AGI. And this credit is going away. So if you're ever interested in EV, now's the time I would say to capture that credit, okay? Alternative fuel refueling property credit, pretty much like EV chargers at your home. So this this credit is also going away end of December 31st this year. Residential solar tax credit, this also is going away at the end of this year. And then commercial solar tax credit, the deadline is 12/35 with a phase out over a 3-year period. So pretty much all the energy or what do you call it? Green, clean energy initiatives are kind of going away. All right. Do we have a question? Okay, perfect. Opportunity zones. So are you guys familiar with opportunity zones? If not, I can break it down at a high level. I'll talk about it at a high level. I don't want to go too deep into it. But opportunity zone is a real estate tax strategy. Is mainly to mitigate capital gains. So if you sell stock, crypto, real estate, sell a business, those are all capital gain triggers. And an opportunity zone is a tax strategy that you can defer the tax and a portion of it could be tax-free over a 10-year period. Okay. It's a very advanced strategy. The minimum usually for one of these for this strategy specifically is $100,000. And initially, it was looking like it wasn't a good strategy anymore as it was expiring under the old law, but now it's back and it's back with a vengeance. So The QOZ program is now set to resume January 1st, 2027, and it even also is made permanent, which is great. So it gives investors an opportunity, if you have capital gains, right, to give new avenues to defer and possibly, again, get tax-free over time for the appreciation of real estate. So opportunity zone is essentially like it's a section determined by the state. It could be in your state, it could be multiple states, right? It's nationwide. And within those states, there's like it could be a disaster area, low income housing area that needs housing. It's pretty much an incentive for companies to go out there and build, right? Um, and so what they do is they raise capital through investors. Okay, they purchase they get the construction loan, they build this property, this resident or commercial property. It could be apartment complexes, whatever the case may be. Um, and so they create these apartment complexes. There's rental income that's involved. And then any appreciation from that real estate over a 10-year period becomes tax-free. That's the opportunity zone strategy in a nutshell. Again, this was something that was expiring, it wasn't looking good, but now it's coming back. So I'm excited to look into it, re-look into it in January 1st, 2027, and see what boosts have come up with it. 1099s. So this has to do two parts to this. The first part is, you guys probably saw the fear online the past couple of years about the government now is trying to report your income for like Zelle, Venmo, Cash App, you name it, right? So they were trying to get into your pockets and try to figure out your personal income and pretty much just trying to get more money, right? The IRS. Well, pretty much with this new bill, they said no, thank you. They axed it. So starting 2026, they're like, we're going back to the normal thresholds, which was $20,000. Okay, $20,000 of income, uh, and then or 200 transactions, whichever comes first, right? So then you'll be issued a 1099K. For example, like if you're eBay seller, you sell over $20,000 or have over 200 transactions, you'll be issued 1099K, and they have to report that income, right? That'll go on the Schedule C. So versus before, it would have been, I think the threshold was $600 or $300. They were trying to get it really, really low. And that would have been disastrous. Imagine another form you have to receive, and then you have to parse through your Venmo transactions. I mean, it would have been a nightmare, right? Um, Audits would have been a nightmare. Yeah, thankfully, that's gone. Don't have to worry about that. Cool. The second provision about 1099s is going to be about 1099 NEC. So in the past, if you paid a contractor more than $600, the compliance requirement is that you have to issue a 1099 NEC to that contractor. Okay, and that contractor would have to report that income. So $600 was the mark, a threshold. Now, starting in 2026, they're going to increase that to $2,000. So this is great. Less reporting for clients. If you're hiring even part-time help, you don't have to worry about the $600 threshold. Now it's $2,000. I still recommend all my clients that are hiring contractors to get a W-9. Okay, get the W-9. I'd rather you have the contractor's information up front, and at the end of the year, we can determine whether a 1099 needs to be issued or not, right? So $2,000 is now the new threshold starting January 1st, 2026. State exemption. This was, whew, I just talked to a client this morning about this. This was a big, big deal. So, state exemption, before I get into it, you know, you work hard for your money. Okay, you've studied hard, you've worked hard, you're a hustler. You've built up this great amass of wealth over time, over the life of, over your life. And then during this process, you're already paying federal tax, state tax, property tax, sales tax, this tax and the other tax, right? And then upon death, you got to pay a state tax. You're not even you're not even here anymore, and you have to pay a state tax on top of it. Oh man, this tax is probably the dumbest tax ever. But we work with what we got. Anyways, what happened in the new bill was that it was set to expire. The estate tax exemption is supposed to decrease significantly, okay, on how much you can pass to your heirs tax-free. Now, what this is locking in and making it permanent, the estate exemption. Starting in 2026, estate and gift tax exemption made permanent at $15 million per individual or $30 million if married, okay? So this is a big deal. There's no 2026 drop as previously scheduled under TCJA Tax Cut and Jobs Act sunset. And the ideal time to update estate planning and consider lifetime gifting strategies is now. So now is the perfect time to meet with your estate tax attorney. If you need a recommendation, we'll happily do so. Ideally, all you need to know is Uncle Sam is going to be having less money in your pockets. Okay. The last thing you need to worry about is this. So make sure your estate planning is up to date. And yes, big deal for my high income earner clients and for you. If you're not at these thresholds, don't worry, you will be one day. Just keep hustling. And just for myself, once we created this mass amount of wealth after hustling and working hard, it's good to know with the right estate planning structure that's going to be going to my heirs, tax exempt. Salt cap. This is just a reminder or a little tax tip, I should say. So we talked about the SALT limitations, right? From $10,000 going up to $40,000 for the next 4 years, and then going back down to $10,000 unless Congress intervenes. I'm sure they will. The strategy here is to bunch payments, right? So what do I mean by bunching payments? Let's say you contribute to charity $5,000 a year. It could be to a nonprofit, children's hospital, your local church. Let's say you contribute $5,000, okay? So with $5,000, you want to do that, let's say January 1st, okay? January 1st, 2025. And then you contribute another $5,000. If you do that every single year, the next $5,000 you can contribute is December 31st, 2025, okay? So instead of contributing 365 days, every 365 days, you're going to contribute every 364 days. And what happens is your charity contributions now doubles, right? You're going to contribute to charity regardless, as you do 5,000 annually. So by doing it January 1st and December 31st, you're now bunching your charitable contributions, your payments, to boost up your itemized deductions. And then now with this SALT cap increasing from 10 to 40, it's just going to give you a much greater itemized deduction, lowering your taxable income and paying less in taxes, okay? Now, this is a strategy you want to do every other year, right? Because you're pretty much doubling up in 1 year, and then you're not doing anything the next year, and then the third year, you do it all over again. So this is the idea of bunching. That's a little tax tip there. Trump accounts. Oh man, we're gonna have a field day with this one. Especially my financial advisors, right? So Trump accounts set to launch in 2026. I can't call it anything else because it's legally what it's called, a Trump account. This is what it is. We can call it a T account, I guess. So it's a new savings opportunity, new tax-deferred savings account for children that are born January 1st, 2025 through December 31st, 2028. Initially, you're going to get $1,000 from the Treasury contribution per qualifying child, and you'll be able to contribute $5,000 after tax money every single year. These investments will follow the stock market, and funds grow tax-free, like a Roth or 529. No withdrawals will be able to do even with. They haven't provided guidance about penalties, but as of right now, the way it's written, there's no withdrawals before age 18. Ages 18 through 24, you may withdraw up to 50% of what's in that account, tax-free for college, starting a business, or first-time home purchase. Once the child is greater than 25 years old, they're used for anything. You pretty much use the funds for anything. And any earnings that were earned will be taxed at capital gains rates, which doesn't make sense to me because you're putting after-tax money into it. It grows tax-free, should come out tax-free, kind of like a Roth. So it's not really a Roth because the gains are still taxed at capital gains. So I have mixed feelings about it. Honestly, I would love to sit down with I'm sure financial advisors will have their own opinions and their own analysis, which I would love to hear on how this fits in someone's financial plan because this is just another investing vehicle, right? So I haven't put too much thought into how it would work overall with let's just say my financial picture if I want to have a third child. You're contributing 5,000 after tax, grows tax free, but then it gets taxed at capital gains rate. So we'll see. I'm sure there's much more guidance going to come out the next few months. So estimated timeline for creation of these accounts are July 4, 2026. Further guidance is to be provided. New HSA and Telehealth Rules 2026. So this is a huge deal For those that have high deductible health plans, but maybe on a not like the gold or platinum, whatever they're called in the for your medical plans, but the lower tiered, right? Including bronze and they say catastrophic plans. So now that they're pretty much expanding the HSA tax strategy, which is a big, big deal. What is an HSA? An HSA is a health savings account. It's an account that you can utilize for qualified medical expenses. And it's the only tax strategy out there that with a triple tax benefit. So you put money in pre-tax, you get a tax deduction for it. It grows tax-free and comes out tax-free for qualified medical expenses. So it's a triple tax benefit. You have to have a high deductible health plan to qualify. And what they're doing is sometimes high deductible health plans, even though you have one, you may be on like the silver or bronze and not qualified for an HSA. Now this will expand those opportunities to put money in. I always recommend HSA. HSA is fantastic. It's an because it's not a matter if you'll need funds for medical, it's just a matter of when you'll need funds for medical. You can use it for yourself, for your spouse, for your family, for your kids, right? And there's a whole list on IRS Publication 502 that lists out all the qualifying medical expenses that you can incur to utilize your HSA funds for. I mean, there's prescription glasses. You can use it. We used it for LASIK for my wife the 1 year, a couple years ago. There's you can use it for your Advil, the pharmacy, co-pays, surgeries, chiropractic care, physical therapy. Like the list is very, very extensive. So if you don't have an HSA, I highly recommend to see if you can get one for this year, or if not, if you qualify for next year, right? So 2026, they're definitely going to expand it, which is going to be a huge, huge deal for everyone. Okay, this is another downer. So not a fan about this one. Not a fan about it at all. Um, Charitable giving limits. So this is a change that's going to happen in 2026. So currently, as the tax law is written, there's no AGI floor for itemized charitable deductions, meaning every dollar you invest in charity, if you're itemizing on your tax return, it's all going to go into the calculation of your total itemized, reduces taxable income, reduces how much taxes you pay. Well, starting in 2026, there's going to be an AGI floor. What does that mean? 0.5% of whatever you contribute, okay, to itemized giving will not count towards your itemized calculation overall, which is really dumb. So let me give you an example. If you're making $1 million AGI, 0.5%, that means $5,000. And let's say you already do that every year. Well, guess what? That $5,000 you're not able to utilize to calculate your itemized deductions. It's every dollar above that $5,000 that then gets contributed or calculated on your itemized deductions. Why would they do this? Why? I'm trying to think logically. Why would they want to limit charitable giving? Yeah, I don't get it. But it's how one of those bad things that came out that I don't agree with from the tax bill. So this is something that's going to start January 1st, 2026. Now, if you're not itemizing, you're still able to get a $1,000 to $2,000 of just charitable deduction on top of your standard deduction. So that's pretty cool. I just wish they never did this AGI floor. So again, we talked about bunching for charitable contributions, January 1st, December 31st, try to do it within the same year, every other year. Real estate. Again, real estate's coming back almost, I would say almost as a very strong tax strategy. It's not there yet. We got to get these interest rates down. We'll see what happens. I know Jerome Powell and Trump are in probably getting a boxing match pretty soon. But ideally, if interest rates start to come down, I can see real estate as another strategy that's going to be really, really good in the future. So depreciation helps shelter rental income, offsets active income if you have real estate professional status and material participation. Cost segregation studies are great to accelerate write-offs. Now with 100% bonus depreciation plus Section 179, you can pretty much accelerate any useful life less than 15 years within a real estate investment property after a cost segregation study is performed. And any passive loss planning can now yield major gains. So this is now becoming a great, great strategy. Close. Maybe 2026. So I love real estate. I have a real estate portfolio that we're trying to grow. We've kind of paused it because of the interest rates and all that. But again, with 2026, I'm already starting to think like, all right, what am I going to buy in 2026? And so I'm excited. I'm excited for this to be a recurring tax strategy coming back in 2026. Car loan. Car loan strategy 2025 through 2028. Again, we talked about this interest deductions. There is a phase out of 200K AGI, but with the right tax planning, you could possibly get to that threshold. Or if you're already under that threshold, you don't have to worry about all the interest deduction that you get to the auto loan will be offsetting your taxable income. Now, what's great about this is that it's $10,000 of loan interest per taxpayer. So if you're married, times that at two, that's up to $20,000 of auto loan interest that you're able to deduct if you're under that 200K mark, right? If you're under that 200K mark on your taxable income and reducing your taxes. So that's really, really cool there. Now, just another tip before we close this out. I think we're almost at the we're already we're almost there. So tax planning calendar. Keep in mind, I like to put reminders in my phone and the reminders app in my iPhone. Schedule charitable giving, okay? Be conscious about when you buy equipment. Be conscious about your retirement contributions, whether it's your 401k, traditional IRA, simple IRA, SEP IRA. Plan around thresholds. Be conscious about those AGI limits, okay? Especially if you're trying to stack multiple strategies on your tax plan. So to reduce your taxable income and be mindful of those phase outs. Also, just a planning calendar creates clarity, okay? With the right advisor, they're going to completely put a timeline in front of you to avoid any missing opportunities, okay? Super, super critical. You work with the right tax professional. So let's recap the top 5 moves to close out this webinar. So max out the SALT deduction window. You want to take advantage of the temporary 40K cap before it reverts to 10K in 2030. You want to make sure you secure estate gifts while the exemption is high. Utilize the permanent 15 million exemption for strategic wealth transfer for single, 30 million for married. Number 3, optimize your QBI and equipment deduction. So leverage the permanent 20% pass-through deductions and look at 100% bonus depreciation, right? So that's gonna be huge, huge. Number 4, take advantage of any EV or energy credits that you possibly can still get before this September 30th this year or December 31st this year before they're gone. So act now before valuable incentives expire if you meet these thresholds. Again, quick refresher, 150K of AGI if you're single, 300K if you're married. And lastly, get a custom plan based on your income and structure, whether that's with a responsible financial advisor, tax advisor, work with a strategic professional to maximize your specific opportunity.